our federal government, that we have grown to love so much is making changes to how they charge us for certain things. First, it was the um, first it was the carbon taxes that everybody cried about. I guess until a few people got a deposit in their account, when people stopped complaining. Oh no, I'm leaking. One sec, guys. Didn't close my bottle properly. Which that's a very polarizing topic, so maybe I shouldn't bring it up. But now, last week, they announced swabbing changes to land transfer tax, sorry, not land transfer tax, capital gains tax, and how they're going to be implementing it for some people. And also to business tax, which the details are not quite out yet. So we're going to discuss that on another date if they continue to go forward, and then we end up dealing with that. And then you guys will probably all remember, because a lot of us got new cars in the last little while. A couple of years ago, they also brought in the luxury tax, or what they like to call the Export Excise Something Tax Act, which airplanes, luxury goods, and cars get taxed in the amount of 15% over 100K. And that is meant for, it's a cash grab, but it's supposedly meant to curb exports of luxury goods and high-end cars. Sucks. I got hit with it. I ordered a car, around the deadline, and it took so long to come that they gave you a grace period, and my car took longer than that, and I ended up having to pay an extra, I think it was an extra $9,000 or something like that on top of the cost of my car, because, like the government does, it's not just on the price of the car, it's on the price of the entire total after taxes and upgrades and dealer add-ons and whatnot. So anyway, so now we're dealing with capital gains. And this talk is going to be based on an article that I read. There have been tons and tons of articles. A lot of them, when they made the announcement, it seemed pretty clear. But then there was tons of articles, lots of things in the news. And I don't want to use the word misinformation. It's not fair to say that. But a lot of opinion is mixed in with a lot of these articles. At the end of the day, these are people who want to be read. They're people who want to be noticed. And, news outlets that want to bring better results in for their advertisers. So, after reading articles, I found myself a little bit more confused with everything than I had started out. I had more information, but in terms of the functions of things, it wasn't 100% clear. It was more just a lot of opinion pieces and how it affects certain people and who's going to have an issue with it and stuff like that. So while I was going through it, last week there was an article posted on CBC, which after this talk I will share it with everybody. And it was by one of their journalists. His name is Benjamin Stephen, and what he did was he created an article that was more like if you were to make notes on something. So it's a point-by-point breakdown of the important aspects of the changes and what the changes are. So it helped me kind of feel better about my understanding of things. And I wanted to share the information from his article with you guys. Now, it's important to understand that this is a proposal at this stage, but the likelihood of it not passing later this year, I think it's supposed to pass. It's part of the 2024 budget that the federal government released, and I think it's supposed to pass this summer, which they vote on everything in the budget. This is something which more than likely will pass. So it's important to realize that it's not in effect right now, but it will be in effect starting this summer, more than likely. And at that time, these changes will start coming in. So if you've already disposed of property and you're trying to calculate your capital gains and the closings have taken place, this new method will not affect you. It'll only affect you on closings after that. Now, I'm gonna ask for somebody to volunteer. Who here knows what capital gains is? Anybody? No? Okay, cool. So capital gains, based on this guy's write-up and actually what it is a capital gain is the difference between an asset's cost and its total sale price. Okay? So you have an asset and you've bought it at a certain price, and then down the road you sell it at a different price, and the difference between those two numbers is the capital gain, the gain in the capital that you make on that asset. Now that asset, it could be more than just a home. It could be a cottage, it could be an investment property of any sort. It could also be a stock or a mutual fund. So for those of us who are trading in stocks, that is something that's supposed to be reportable as a capital gain. Those do qualify as a capital gain. Now, because we're talking real estate, we're going to keep it real estate. And as an example, if one of us bought a property for $750,000 that we didn't live in, it was just an investment property, like let's say a cottage, and then later we sold it for $850,000, we would then have a capital gain of $100,000. I'm going to use simple examples here. So your capital gain is $100,000. Now, I use the example of a cottage property only because for the most of us, we live in the city or in an urban area where we don't particularly live in cottages. And I'm sure there are realtors that may have put down their cottages as primary residences for your family. So that would make things different. It's not that if it's a cottage, it is an investment property. It has to be an investment property. So what that means is there are situations that don't trigger a taxable capital gain. And one is, like I mentioned, if you sell your own family primary residence, but also, you know, and it's important to remember that not everybody's the same. So, you know, we might be here at the office and you might see each other here, but some people may have their primary home in a cottage somewhere different. Like, you know, it's not uncommon for someone to live out in Kawartha and then commute to Durham for work, as an example. I'm not sure if any of our realtors are in that situation. I know we had a couple of realtors that were living up north, not sure their situation. So if you sell your primary residence, your actual family home that you report as the place that you live, it will not be taxable. The gain from it will not be taxable. Obviously, you still have a capital gain. You know, if you sell something for $1 million that you bought for 500,000, but that gain will not be taxable if that's where you actually live and that's your primary residence. Another exclusion will be profits earned through, tax sheltered vehicles. So tax sheltered vehicles could be things like RRSPs or RESPs. Now, whatever I say, I'm not a financial planner, so anything that we're talking about, don't take it as financial advice. You need to speak to your accountant or financial planner to strategize how to make things happen, how to make things work. But if your income is made within an RESP or an RRSP, that is not taxable. Now, if you withdraw, that could be a different story depending on the situation. Okay. Hello, come on in.
Oh,
yeah, come on in. No, well, people are online. Everyone else is running late. I guess they assume that I'll be late. I'm gonna take it easy. Okay, so who knows? Now that you know what a capital gain is, who here knows how capital gains are taxed? Anybody? Do you know how capital gains are taxed? Okay, tell me.
So, solar price, I think total, kind of big. So total, how much you are like gaining, half of it. So it was previous. Now
Right.
it's 66%.
So Era is here, and she has given me the right answer. So capital gains are taxed like this: 50% of the gain. So in the example that we used earlier, somebody made $100,000 gain. $50,000 of it is taxable. $50,000 you get to retain tax-free, and $50,000 you will be taxed currently. Does anybody know what the tax rate is on a capital gain?
It's on your income.
Yes. Now, this is something that we need to be careful about. I've heard a lot of realtors say that, oh, the tax rate is X amount of percent. And that is incorrect. So what happens there is your taxable portion of your capital gain will be transferred onto your personal income. Once it's on your personal income, whatever your tax rate or your marginal tax rate is based on your income level, that'll be the number that you're taxed on overall. So a capital gain doesn't have its own tax rate. It gets added to personal income. So when you're dealing with your clients and you have investor clients, or even better, the more likely situation is we're creating investment clients. We're creating, people that have either generational wealth or savings, or they've been in their homes that we've sold them for a while and they have equity. Now we're advising them that, hey, you can start making money through real estate versus just living in a home. A lot of them are going to be getting this information from places. So it's important to understand, to explain to them that the capital gain, and of course, tell them to speak to their accountants before and while doing everything. But don't give them the wrong advice. Don't just chirp out what you hear other birds say, right? Which what I've heard is, oh, capital gains, it has a 25 or 26% tax rate or has a 35% tax rate. That's incorrect. Because if you've got income over $203,000, or 204, I forget the number, then all that money that you're making on top of your income, it's a 53% tax rate, right? Because that's what the tax rate is when you reach that number. So it transfers onto your personal income. Whatever your tax rate is, not what it is before the gain, but what it is after the gain, that'll be the tax rate. But it's not just on the gain, it's on your overall income. So it's 50%.
Now it's 66, right?
And here's the other thing that was confusing me, the misinformation, which we'll talk about the change. So what's changing is now that 50%, that's what they call the inclusion rate. So I know that in the news, you've heard this word inclusion rate being thrown around, and they don't really explain what does this mean. The inclusion rate is that 50%. Okay. So up until today, up until now, the inclusion rate is 50%. Again, reiterating, that means that 50% of your capital gain gets included onto your personal income tax number. That's why they call it the inclusion rate. So what they're doing is they're actually keeping it that way. And it took me a little bit to uncover how this works, but they're keeping it at 50% for individuals. What changes is the portion above $250,000, right? Remember, now you want to think about this in a non-confusing way. Remember when we learned about land transfer tax, how different portions of it have a different rate, and it escalates as the price goes up. Same thing here. So if your gain is up to $250,000, the inclusion rate still remains 50%. The moment it's over $250,000, just the portion that's over $250,000, the inclusion rate for that portion changes to 66%.
Okay.
So, and this is what some of the stuff that's going on in the news is messing people up with. Everybody's out there thinking that capital gains is now 66% total. And although that's not entirely untrue, because we'll talk about the scenario that it is the case, it's not. It's the portion over 250K. So let's use an example of, actually there was an example in here. Let me skim through and then I'll tell you what it is.
What about commercial properties?
Commercial property is a different story. Commercial property that's business income. Okay. And also, Neil, because you brought it up, okay, business income is an argument that a lot of your investor clients and maybe yourself will have with CRA if you are consistently making money on property. You know, Neil, if you're just a guy and you have savings and you buy a property, it becomes an investment for you, and then, you know, it's run its course, now you're getting older, you want to, you know, change the way your assets work and you sell the property, you want to give money to your kids and family, or, you know, pay off your existing whatever the case is, right? It becomes capital gain and it's all good and it's black and white. However, if CRA starts seeing a pattern of flipping, right? And you are now looked at as a flipper overall, like you're buying a property, selling a property, buying a property, selling a property, buying a property, fixing it up, putting some lipstick on it, making it prettier, and then selling it. They look at you as a different type of entity. You're not an individual anymore, right? Now you're doing this as a business. And if they start feeling that, hey, the real estate flipping game is a business for you, they will look at it as business income. Not entirely a bad thing, to be honest, but it's a little bit scary because now they're going to be taxing the entire amount, right? So if they're taxing the entire amount, then obviously it's going to cost you more money. But there's also benefits in doing it as a business, legitimizing yourself, right? You can start writing off HST. You can start, you know, opening business bank accounts, getting business loans. Like everything starts changing a little bit. You know, wealth management becomes easier, but commercial property is business. That's not personal. So, you know, commercial property has things like HST. It has things like tax on every single piece of the income that comes from it, whether it's from rental income or from selling the property, making a profit, whatever the case may be. Mind you, when you have an investment property, the rental income that you have is taxable as well. It's more of a subject to speak to your accountant in how you can offset the income. As an example, we've got lots of clients who are spending $3,500 to $4,000 a month carrying condominiums that are renting for only $2,700 a month. So if they just start paying income tax on the $2,700 a month, they'll be in a worse condition. But a proficient accountant can offset and be like, hey, the year-on-year income is actually at a loss, right? So that's something that you can consider as well. Now, the example I'm going to use, I think he used an example of $300,000 of a gain. I can't seem to find it right now, but let's just roll with it. $300,000. So let's say, Neil, you sell a property, you have a gain of $300,000. In that event, 50% of the first $250,000 will be included onto your income tax. So $300,000 is your gain, $125,000 is taxable straight off the bat, right? That leaves the extra $50,000 in gains that you had. Now that $50,000, 66% of it, which is $33,000, gets transferred onto your income tax. So what we're looking at $183,000. Is my math right? Look, you're a calculator kind of person. So yeah, 150 plus, no, 125. I'm sorry. You make 300,000, 125 transferred over plus 33. So your taxable amount is $158,000, right? So here's like what the difference is. And it sucks, but it's not a huge difference. So $158,000 gets transferred onto your income tax. Now, let's say if we look at the old rules, how much gets transferred onto your income tax if you make a $300,000 gain? $150. So this is $8,000 more in income that you have to cover for taxes. So if your tax rate, look, if you've made that much money, you probably have another job, you probably are in the 53% range at this point. So on your tax return, Now, you guys do your write-offs with your accountants, whatever you want to do. It's going to cost you 53% of $8,000. Make sense? So you're looking at about $4,000 something more in taxes now versus earlier, if you made a $300,000 gain. So it is more expense, but it's not as bad as people thought, because what people keep throwing out there is the 66% number. They say, when you think about it, it going up to 66% from 50%, that's a huge percentage increase, right? That's a 33% increase from 50,000. But it's not exactly a 33% increase in your taxes. It's just the inclusion rate changes after the $250,000 mark. Okay, so that's how it works, and you can use 100 different scenarios. Let me actually put one on the board, and then we can work it out. So I personally think, like, I've got investment clients and they've sold properties, and typically people don't make as much money as others think. $300,000 is a very healthy capital gain. They have other income that they see from the rental and things like that they make. But let's say somebody really blew it out of the park. Let's say I'll use an example of mine. Like, my last house that I moved out of before I moved into my current one, when I bought it, it was $530,000, right? Let's just say it's $500,000. I know you guys probably can't see this, but I'll say the numbers out loud. I sold it when I moved, so the equity went with me, and I'm in my primary residence. If I ever sell my primary residence, there's no tax on it. But let's just assume for a moment that I kept it and I sold it today. If I sold it today, I would probably sell it for $1.5 million, with a capital gain of $1 million, right? This is not common, but we do have clients that are in this situation where they've lived in a house with their family, then they bought another house and moved into it and kept the other house and rented it out top and bottom, whatever the case. This does exist. And it might be 15 years later that they're selling it. In that case, they might have $1 million in equity. In capital gains. Now, in the old rules, it's very straightforward. $500,000 goes towards their income tax mathematics for the year that they sell the property. And a lot of smart people, that is a big reason of why they don't sell property, right? Because they don't want to put 500,000 onto their spreadsheet to pay $250,000 in taxes, actually a little bit more. The benefit of selling starts to erode. It's better to just hold on to it and have cash flow. So 500,000 goes towards your income tax. Now, in the new rules, the way this will work is we're going to take $250,000 and take half of that and put it towards our income tax. So $125,000 goes towards income tax. Now that leaves $750,000. We've already taken care of the first $250K, right? So now we have to worry about the other $750,000. You have your calculator? Let's do 66% of $750,000.
$495,000.
$495,000. Look at that. That is almost the entire amount from before. So when I add it all together, I'm looking at $620,000. So in these kind of scenarios where the numbers are higher, where the income from the property is significantly higher than like your average run-of-the-mill flip or sale of an investment property, this is where it makes a huge difference. If you have $1 million of capital gain from the sale of a property, before it was $500,000 that goes towards your income tax. Now it's gonna be $620,000, right?
Huge.
Right. So what does this tell you? This tells you that the government is trying to take a piece of the pie from people who are making a lot of money, not from people who are making a little bit of money.
But they're gonna hold it. they're not gonna sell it.
At this point, they're not going to sell.
So,
If they thought it was a bad idea to sell before, it's a really bad idea to sell now. Isn't that right? But now, me looking at it from I want to keep as many eggs in my basket as possible, what am I going to do? I'm going to develop a strategy where I'm picking up properties, and as soon as I can sell them for $250,000 more than I paid for it, that's the time to sell and then get into the next one.
So the thing is the margin of capital gain is the concern right now.
Yeah. So Suman, as long as you are at $250,000 in income from the capital gain, you're not affected at all. If you hit 300,000, you're barely affected. You hit $1 million in capital gains, it's a big deal. You're losing quite a bit of money. You're going to lose on this. It's $120,000 more transferred over. So 53% of that 120,000, you're just giving to the government. That might be like around 50,000.
Which means a lot of
$65,000.
sorry, forgive me. Which means a lot of investor or realtors, they will push for client to do a short-term investment instead of long-term. Am I right?
Right, exactly. So maybe the game now becomes, instead of like collecting one at a time and then building your portfolio to be a huge portfolio at the end of the day, if the goal is to liquidate at any point, right? Because some people also build a portfolio with no intention to liquidate at all, ever, to put it into a trust for their children or whatever the case is. If the intention is to build a portfolio to cash out down the road, maybe it's a more active portfolio. Maybe it's one where people are buying stuff, holding on to it for like 5 years, and then selling and then moving to the next. Like Suman, in your neighborhood, when I sell for the same price, I can buy one, right? So instead of just keeping it, I could also just sell it and buy the next door neighbor's house. As soon as the day comes that I get a deal in the neighborhood, I could grab it and sell mine, right? Now, obviously, like I mentioned, this amounts to about a $60,000 or $65,000 extra in tax. So you have to look at your opportunity cost as well. You have land transfer taxes, you have commissions to pay, this and that. So maybe the $65,000 in savings on taxes is not worth the $65,000 you'll spend in doing the whole thing. But it's really up to the person, right? What feels right for them. This is an increased tax that we'll have to pay on our gains. It's a reality. It's coming. It's not in effect yet, but it will be there. Canada is one of those places where, like, if you've got some money, it's easy to make money. However, it's very difficult to keep the money, and they are making it harder. Now, I will talk about the truth behind the 66% actually applying fully. Where that applies is for corporate entities. So everything I've talked about up until this point is for personal gains. So Suman, you, Neil, you, me, Era, we just buy in our own names, right? Then this new way is the way the tax works. But if we buy through a corporation and we own the property through a corporation,
okay,
now 66% of all capital gains. Yes.
okay,
Now 66% of all gains are taxable for a corporation. And this is why you see in the news yesterday or the day before, there was a whole thing about doctors speaking out about it, right? I don't know if you guys saw that, but the Medical Association and doctors were asking for the government to reconsider this because it'll make a massive difference to the retirement of doctors. I don't know if you guys know this, but if you have friends who are doctors, none of them are employees. The ones who are employees, it's very rare. And the ones who are employees, they get lower pay and they get, like, pensions and stuff like that if they complete their employment cycle with their employer, which is also very rare. But when you talk about GPs, like family doctors, anesthesiologists, ER doctors, whatever the case is, they're all incorporated. So under the OMA, they run what's called a medical practice or association. So it's, imagine like a prep for a doctor. And when they do their work and they get paid, they don't get paid directly to their names. And the reason they don't do that is because a physician might have $150,000 in expenses that they need to cover for day-to-day stuff, mortgage payments, school payments, like whatever the case is. But 1 year they might make $150,000 because they take a lot of vacations. And 1 year they might make 700,000. So in order to avoid paying taxes on all of it, they get paid just like we do in a PREC in the corporation, and then they give themselves a paycheck. Right?
Yeah.
And
You change the strategy.
in the public opinion, I'm hearing a lot of people saying that, oh, this is cheating the system, it's evading taxes and stuff like that. No, it's not. It serves a function. People who are self-employed or people who are incorporated, we don't have retirement savings, we don't have pensions. We need to build our retirement with the wealth that we generate in our corporations, right? So what doctors have been doing forever, and not just doctors, but everybody's incorporated, unfortunately, except for PREC, we unfortunately so far don't have the right to own property as a PREC. We still have to transfer it into our own personal account, pay the taxes, or transfer into a hold corp, and then our hold corps can buy it, right? On behalf of our PREC, but the PREC cannot own property. PREC can only do business stuff. So what they do is within their medical corporations, they purchase properties, they buy stocks, they make investments into mutual funds, they do all this stuff, and it generates income, some of it, and some of it just generates equity. And then when they retire, they'll either draw upon the equity, or they'll sell one property every few years to generate the money that they need to survive. Until they die, then the will takes over. And so the argument is that if they are going to be paying 16% of a higher inclusion rate, which is a 33% higher effective tax, then what's going to end up happening is, first they're saying that, hey, it's going to affect doctors' retirement. We can't afford this. We don't want it. Sounds like crybabyiness, right? But what they're saying is this will create a lag. It'll make physicians stay in the profession longer because they will not be as prepared to retire as they had planned. And it will mean that there'll be more pressure on the system to hire doctors coming out of medical school. Medical schools will have to slow down, but they won't. But the government will now have to put lower quotas on the amount of students graduating from medical school. It'll make medical school more expensive because it's less accessible, and it'll have a massive impact on the medical profession and availability of services as well. Which, when you read into like why they say these things, it is true. If doctors are financially uncomfortable, if their plan gets changed, if they get railroaded, obviously,
They'll ignore.
yeah, they'll have to stick around longer. Slow old doctors will have to stay around.
I want to say something. So I went to see my doctor at Sunnybrook yesterday, and the another doctor, the family, I saw them distracted. So I asked them, are you guys okay? You had your lunch. So can I take you to a doctor? Now I know what all the ways.
Yeah, now you know why they're pissed off, right?
Yeah. So the guy changed the topic to Maple Leaf game with Boston, but that was not the case. The guy was thinking about his properties. Oh my God.
Yeah, he's thinking like, oh man, I was planning to sell like 2 properties next year, and now it's going to cost me an extra $300,000.
Yeah.
That's probably what he was, especially if he's an older guy, right? So, and this is doctors, but listen, it's all of us, right? I have a PREC. I do have holdings. I have a holding corporation. As a matter of fact, that's what owns my share in this company, the hold corporation. So what happens down the road when I want to sell that? That is a capital gain, is it not? I got to pay higher tax. And then the amount of wealth that transfers that's left over for my children at the end of the day is reduced. So what does that mean? That means I got to make more money. How do I make more money? I can't just make it happen, right? So I have to put more pressure on you agents.
Oh my God.
Right? But reality, that's not what it is. Everybody's working to their potential and like figuring out their potential. You can't just tell somebody, Suman, sell $3 million more worth of real estate this quarter. I can't do that.
No.
You have to get to that point, right?
You have to hire new agents. Yeah.
Sure, yeah, that too. But the point is, business has to get there, right?
Sure.
So what does it mean? It means that I might have to work 9 years longer than planned. Sure. This is where the change really comes in place for the corporate side of things. The personal side of things, it's a tax cash grab.
Should I tell the Indian parents that don't make your kids doctor, now make them engineers, or what should I do?
I'm not going to say anything about that, but you know, a lot of engineers are paid on invoice as well,
Yeah.
right? So they're
I had a
also
question.
incorporated. Who's that?
It's Hassan.
Hey, Hassan.
Um,
HJ. Oh, that's a okay.
yeah, sorry. Is there an effective proposal of getting investors to move properties from the corporations into personal hands then? Is that an incentive? Because they effectively get to save $250,000 on an inclusion rate.
I don't know
Because if
about
they,
that,
yeah,
but I will tell you, and from an experience that I've had with clients of my own, that when they transferred, like I actually have one client that I'm just going to use this example. He transferred a property from his personal to his medical corporation at one point. And when he did it, he had to pay land transfer tax
yeah,
on the entire value of the home, which was crazy, but he had to pay it. And he did it to avoid paying capital gains tax on it because he planned to keep it for a while when he moved to his new home. And he thought, let me just turn it into an investment, but let me put it on my business side because business, you know, it's a lot more flexible. It's easier to own property under the business. And he wanted to start building his holdings under his medical corporation as well. So that capital gain ended up adding up to a lot of money. And he lost money there. And then eventually he did sell it. Now, what he did, this particular doctor, he developed a slightly different perspective, and he ended up going into like more of a government job as opposed to working, you know, as a private physician. And when he did that, it decreased his income and things, you know, things changed. He ended up selling the property under the corporation as well. He thought to transfer it to back to his personal ownership first, and I don't know if it was his accountant or financial planner, whoever he was dealing with, they advised him against it. They said, just sell it. If you're going to sell it, just sell it and pay the tax and do what you need to do. But you know, this goes down to like when he switched jobs, the medical association no longer had income. It only had savings. So it was an issue to hold on to this property because, you know, mortgage renewal was coming up down the road, and he wouldn't be able to renew a mortgage under the medical corporation without medical income. He was now getting a personal paycheck, right? So in any case, he ended up selling it, but him transferring it back to his personal, it would still count as a disposition of property. So when you don't make a gain, you still make a gain. He would have to pay the tax on the income from the sale because I own a car under my corporation, right? And one of them, I end up buying another one and I have to sell the other one. So the first one I want to sell, I thought at first, I'll transfer it to myself. I'll sell this $120,000 value car to myself for like 50 grand. Seemed logical until I discussed it with my accountant and he said, do not do it. He's like, if you do it, you have to transfer very close. You can give yourself a small discount, but very close to the actual value of the car to your name. It has to be a sale. It can't be like corporation can't gift you a car. The corporation can't gift you a home. Just because you're the owner of the medical corporation doesn't mean that the medical corporation can just be like, here, this house is now yours. You have to sell it. You have to sell it at fair market value. If you don't, CRA will come and look at it. And apparently, one of the biggest things that they look at is when a corporation transfers vehicles and property into their directors' names. And I don't have much experience with this except for that one piece of advice. But Samim probably has ample experience in this because he has a very diversified set of investments, right? So and a lot of it is owned under corporation and some of it's owned under individual. So he has, you know, we have our own accountant for the company and he's also his own accountant as well. So, you know, you can't just do that. Like realtors get caught up with restaurants, right? And when they're incorporated, they get caught up with this sort of things. And I'm assuming it's gonna be the same for physicians. So he would have to pay the gains tax on it twice. Once when he sells it to his personal ownership, And then again, eventually when he sells it from personal to like selling it to somebody else. And then he would also have to pay the land transfer tax on it again, right? Plus the legal fees and blah, 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 blah. So he probably would have lost a couple $100,000 more if he transferred it to himself before disposing of it, or even without disposing of it. Does that answer your question? It's not an
Yeah,
answer, but it's something to discuss with a chartered accountant.
yeah, I think the only way to actually consider situations like that is when you actually do a cost benefit analysis, put the dollars on an Excel and just work through it. But another suggestion would also be, say you own an investment property personally. So, and you don't plan on selling your primary residence, you can always elect the Section 45 election to not change in use your investment property for 4
Are
years.
you an accountant, Hassan?
Yeah, I'm a tax accountant.
Okay, so can you answer this?
Yeah.
If we pay 66% of our gains on a corporate level if we sell property,
Yeah.
is that tax rate the business tax rate, or do
Yeah,
they?
business tax.
So there's still an advantage in selling under the corporation there.
Yeah, because businesses have a much lower tax bracket, they get abatements and everything. So that's when it makes sense to put properties in a
Oh man, since you're in the audience, I'm so
And
glad
as
I
well
used a
as,
different
like,
word like and stuff.
Hey, Hassan, you should come for all our meetings, man.
Okay, Hassan, you will be the
difficult.
person giving the training on tax related issues like
Oh,
this
God.
next time.
Hey, Zakir, I have a question.
Yes, sir.
Sorry,
Suman.
somebody else was asking. Can we give that her a chance first before me?
Oh, is there something in the chat there?
Somebody asked something.
So nice of you.
No problem.
Zakir looks cool, man. Any plan for today after the capital gain thing? I have plans after this. You want to come join me? I
Okay,
think Suman
question.
just asked me out on a date.
Question. So what I understood, and Hassan, Samim, Zakir, whoever has the knowledge, correct me. So I understood that if a person, let's say Mr. X has a personal account, Mr. X has 4 property under his or her name, his name, in under personal. If Mr. X has no money left under the personal account, now Mr. X wants to have, but has money sitting in the business account, Mr. X wants to have a 5th property under the corporation of 6th. Mr. X is going to pay more tax, or he will never be able to give it to his family or whatever. He has to sell it when he's selling the 5th and 6th property from the corporation. Is that right? The investment properties.
Hold on. So this guy, could you repeat your question in like a more
So the person, Mr. X, has 4 properties, all the 4 properties under personal name, and now he's out of money from his personal account, but his business account has money sitting. Now his goal was, he has 8 kids or 6 kids. He wants to give the kids, the properties. Now, because he's going through investment, the corporation account for the 5th and 6th properties, can he still give it to his family, or how the tax works, or he has to sell it whenever he chooses to decides to sell it?
It would be a terrible, yeah, so it would be a terrible idea to go and give your kids actual properties in their personal names. You're better off putting it in a trust.
Can't hear you, sorry.
Yeah, Hassan, your signal is breaking up there, so it's not consistent. I think what he said was,
is that better?
oh,
Yes,
much
please, yes, please. Thank you.
Yeah, sorry. So what I was saying is it's terrible to actually transfer properties to kids in
Hassan, you're breaking up.
personal capacity. Like Zakir said, you'll be paying LTT.
Hassan.
Sorry about that.
Yeah, Hassan, your phone is like cutting in and out while you're speaking.
I'll type.
But I think what he's saying is when you're transferring property into your children's names in this manner, that you'll be exposed to more expenses through capital gains and land transfer tax, and other things. So his suggestion is to arrange it to be transferred into a trust where the beneficiaries of the trust are the children instead. Is that correct, Hassan? Yeah, right. Also, Mr. X needs to not be so damn busy with 6 to 8 children and a whole bunch of properties and No wonder he has no cash left in his personal account.
No, that was just a scenario because based on the last 5 minutes conversation, I understood.
Eh,
that-
Hassan,
sorry.
can sorry to interrupt you. Can parents give to children without any capital gain? As a
Oh,
gift?
I know the answer to this. Let me answer before Hassan does.
Yeah.
So a parent can transfer property to their children without any tax, including like if they sell if the children then sell the property after they inherit it, they will not be taxed on that income as long as that was the actual primary residence of the parent. So if my parents give me their house, on the bill, right, and I get it, and it's the house that they live in, and if I sell it, that's my cash. In terms of capital gains, at least, I don't know about other taxes, but that's not a capital gain because it's the primary residence. If they pass on investment property, then that is going to be taxable. And is that correct, Hassan? Yes.
Yeah, but there is a way. I guess you had to talk to like a lawyer and accountant. If a primary home, they can transfer to the son and they move to another house, use that as a primary home.
Yeah, and look, here's the takeaway from this. There's things that are changing, there's things that are going on, and the public is watching the news and reacting to it. So it's absolutely crucial for us to understand what is going on today, what the changes are, what's being spoken about. We cannot be the only person that doesn't have a clue as to what they're talking about on CP24 and CBC, right? But when it comes to taxation, I don't know if you guys noticed, but I'm being very careful in what I say. I'm holding back a lot of things that are in my mind because I don't want to risk saying something which is inaccurate. And then you guys go and tell your clients this, and then one day you get a phone call being like, hey, you effed me over. I have to pay an extra $36,000 in taxes because of what you told me. So what I always tell my clients is, hey, I'm happy to do this for you. You want to sell this property, you want to buy this property, you want to do this, do that. You have taxation questions. Why don't you run everything through your accountant first? And if your accountant is just that $65 tax return guy, get a real accountant, speak to them, start paying them to help you plan your stuff. Once you understand what your situation is and what your options are, then I'll help you out. But a lot of times our clients, they just assume that because we do this, I've been in the business almost 2 decades, a lot of you guys have too, they just think like, hey, this person knows the rules 100%. And we know the selling rules, but we don't know the tax rules. We don't know the tax loopholes. We don't know. And with taxes, everybody's scenario and everybody's situation is different. That you give a blanket statement on something, it could be very much right for one person and very much wrong for another person. So when somebody puts all their cards on the table with their accountant and exposes what their financial makeup is, then that accountant can help them not only understand their situation and their liabilities in terms of taxation, they can also start helping them with structuring things, with strategies and avoiding, exorbitant taxes and moving things around in a way that for the long run is better. We can't do that. Not only do we not know, but it's also wrong for us to provide that advice, even if we do understand some of it. Like, I might have found myself in the exact situation that I see my client in. And I can tell them anecdotally my story, but I can't tell them do this and this and this, and then this is how it's going to work out. Because who knows, what happened to me might have just not been noticed by CRA. Or maybe there's other parts of my tax portfolio that affects how things worked out for me. That doesn't work the same way. Hassan is putting some advice here. I want to put this out there. The vacant home tax may apply to many investors who have properties not resided in or taken possession of new builds they have not filled with tenants for 6 months. This is a 1% of the assessed value added to their income. That's very important. Thank you for sharing that. There was a movement to remove this vacant home tax in Toronto, and it was flat out rejected. So it is there. Despite the issues that they have with implementing it, it's still our responsibility to make our reports. So make sure if your property is rented or whatever, report it. Forget about and this is city too, right? So Hassan may know better, but my assumption is that you reporting that it's occupied by a tenant to the city is not the same as you reporting to CRA. Mind you, my personal opinion on everything is that you should report things truthfully. I know that none of us want to pay taxes, and if we can avoid it, we would want to. But remember, this is tax. This is not like taking money out of your bank account. This is you have income that you have, and a portion of it doesn't come to you. You're still making money. We start getting greedy when, you know, when people started. I remember when I got into this business, when people made like $50,000-$60,000 on a real estate transaction, they were excited. They were excited. Now, when somebody makes $400,000 and has to give up 100,000 of it, they forget the fact that they still have 300K that they didn't necessarily, you know, slave over. So I personally think that report your stuff, pay your taxes, and it becomes a lot easier then if CRA notices it later and says, hey, pay us this much money by this 30-day deadline, and they want a crazy amount of money that you can't just come up with because you've already bought a new Range Rover that is now worth 50% of what you paid for it. So, you know, that's my opinion, but very good advice from Hassan. Apparently, I did not know this, but if a new property doesn't get tenanted or occupied within 6 months, then it may trigger a vacant demarcation. So put some thought into that. And remember, all this stuff, like all of it, you guys should have very competent accountants with being in this business. Run things by them. Even before you like start speaking to your clients, talk to them about these changes, you know, get some insight from a professional before you talk about it. And when your clients are dealing with stuff like this, advise them to discuss with their accountant and let them know that whatever you know, whatever you're telling them, it's not tax advice, that you're not qualified for it, that you may have a flawed understanding of things because you didn't. Look, Hassan is a registered accountant. He can tell you what kind of crazy process it takes to become a chartered accountant or a certified, whatever it is. It takes years and it takes lots of study. It takes lots of understudy. It takes lots of work that gets checked, right? It's a grueling process. People think that, oh, like this guy couldn't become a lawyer, so became an accountant. No, becoming an accountant is no joke. It's a big deal. It takes a lot of time, a lot of knowledge, a lot of effort, and we can't pretend to know what they know after just slanging a few houses, right? So always recommend that the accountant is one of the first stops before anybody heads down the journey of, like, you know, investing, but even more importantly, disposing of investment property. They need to understand their tax liabilities, because if they don't, you know, you make $200,000 and you buy an island in St. Kitts, then, you know, someone's looking for that money afterwards. Suman.
Yes, I have a question. So, you know, I have quite a few clients are asking for a CMA because they moved into their house 6 months ago and they forgot to get a CMA because that was their investment property. Now it turned into a principal. So their accountants, they talk to your realtor, get you a CMA. Now, when I
is that what you were messaging me about?
No, something
Oh,
else.
no. Another, you know, another client messaged me about the same thing. Okay, so first of all, understand that, and I've been through this, CRA has already done their CMA. Okay, they're just giving you an opportunity to present your own. Okay, so when you do this for them, make sure that it's factual and not slanted too much. It can be slanted a little bit, but if it's not within the realm of what they've already looked at, then it's not going to work out. It's going to basically open it to more scrutiny. So CRA does have realtors working for them. Like, they have licensed realtors on their team that log into Realm and look at all this stuff. They also have certified appraisers that work for CRA. They have an entire real estate department, right? And then also realize that, Suman, when your clients or friends ask you for like a CMA, if you do a good job on it, CRA will accept it. But you are not qualified to write a letter of opinion of value, right? Only a certified appraiser is. So you start messing around with this stuff, And now they're like, okay, cool, certified appraisal, please only. You know, and they won't accept the CMA anymore. So you start getting to that. Appraisers, sometimes they appraise things properly, sometimes they don't, depends on the appraiser. They also charge up front. So like you get a certified appraiser to come in, you're paying them that $850 or whatever the fee is, $800. I don't know. I don't remember anymore, but I think the last time I paid for an appraisal, it was $750 plus HST. So it was like almost $900. And that appraiser appraised my property at like 25% under what I sold 2 doors down for my neighbor. And values were going up at that point. And I was like, what are you doing? I can't use this appraiser. And I had to pay another appraiser. And I found out later, and like, you know, through talking to this appraiser, is this appraiser is typically hired by banks, like lenders that aren't like the top 5 retail banks. They work for like private lenders, they work for trusts, they work for mixed, they work for private lenders. So they're in a habit of appraising low in order to protect the person that pays them and gives them the business. So that I said, well, you should do your job accurately, not strategically. There's a reason why you're a certified appraiser. And on top of that, today I'm the one that's paying you for this.
Exactly.
So, right? But
Yeah,
and that's the
that's
thing
the
with
point.
appraisals, right? Every now and then you'll come across an appraiser that gives you an appraiser that you look at and you're like, this is BS. If I sell this property, I'll get $250,000 more than this right now. Right? And sometimes you get
Since
appraisals.
he's charging low price, he should also, low, he's giving you a low number. He should also charge low, like $150.
Man, I wanted my money back that day. But you know, but sometimes you'll get an appraiser that comes in and gives you like a crazy number. I've had clients that have been like, hey, I've had my house appraised by an appraiser before you've come, and they've told me my house is worth 1.4 million. And I'm looking at this townhouse that I'm like, dude, like if you spend $150,000 on this townhouse to make it the best townhouse in Ajax, then maybe I can get you $1.1 million. This 1.4 number came from an appraiser that you found to give you a number you wanted. Doesn't mean it's gonna go.
Yeah.
So your mileage varies. So the whole point is when you're dealing with CRA with these kind of requests, you got to be realistic with your assessments. Otherwise, they're not going to talk to you anymore.
So quick question. So how can we protect us as with a disclaimer every time we are talking to someone or giving any information related to real estate or other profession? How can I say, which I use? I always say, please understand this is just an idea. This information is may not be 100% accurate. There will be here and there. I always say something like that, use something like that.
First of all, don't give advice on things you're not qualified to give advice on.
Okay.
First and foremost, right? Because it's not just that you don't know and you might be wrong and whatever. It's wrong. And actually, I don't want to say this often, but it's illegal. You know, the Real Estate and Business Brokers Act, you know, they use the word act. That means it's law, right? So when you are operating outside of the realm of what you're qualified for, it's a violation of the Real Estate and Business Brokers Act, right? It's actually illegal. You can get charged for that, and then if you end up getting sued, you like good luck. You know, all the losses are on your head potentially. Like if a client goes that far, the only way to protect yourself is to not venture into waters that you're not supposed to be in. Now, if you're going to do it anyway, you have to be very clear in the fact that this is just an opinion. And you have to let them know that it's an opinion from somebody who doesn't actually know this. Because, you know, Suman, you might be a friend to some of your clients, but when they're asking for real estate advice, they might say, hey, I trust you, that's why I'm asking you. But at the end of the day, this is a professional service, right? They're asking you professionally for your opinion. So once you start giving an opinion, doesn't matter if you say, hey, this is not like, you know, you should still talk to an accountant. The fact that you're giving any advice at all is a problem, right? So I understand that in real life, you do have to have these conversations, right? But if you don't give advice that you're not supposed to give, then you can't be in trouble for doing so.
Okay, got it. Thank you.
Okay.
Very good.
The best bet is to stay out of it. And if you absolutely can't, like, you know, sometimes like, you know, for me, like my parents will ask me, what do I do? And if I say talk to an accountant, they won't listen to me. They'll be like, no, you tell me what to do. And I'll tell them, like, listen, this is what I think, but like I'm not an accountant. Like you're not gonna ask your oral surgeon for advice on your heart surgery.
Yep.
And they might help explain certain things to you, like medical procedures, because they are doctors, they are surgeons. But in matters of like which direction to go in with your care of your heart, they will tell you straight up, I'm not qualified to give you an opinion on this lower left ventricle of your heart. Like, sorry, I went to medical school and I learned it and I understand it and I've been exposed to it, but I'm not an expert in this. That's why you have a cardiologist.
Amazing. Thank
Go
you.
consult with your
Very well.
cardiologist.
Yes, very well. Specialist. Yeah.
Yeah, just like you have a Lexus, right? I have an Audi, and I had an issue with my air conditioning on my Audi a few years ago, and so many mechanics would be like, "Yeah, I'm not touching it," and it wasn't, "Oh, I'm afraid to break it." It's because, yeah, I know how air conditioning systems work, but I don't really understand how the workings of this car is, so they don't touch it. So now I have this mechanic that only works on Audis, and this guy does a phenomenal job. He has saved me so much money, and I've realized now that going to the specialist that has a higher rate, I save so much money. Like repairs that I get quoted like $2,600 for, this guy does in like $400, because he understands it so well that he does the right thing instead of throwing a bundle of parts at the car, you know. And he spends less time getting to it because he knows how to take it apart and put it back together. But then I go to him one day and I'm like, hey, I need to get some service done to my dad's car. My dad had at the time a Lincoln MKZ, pretty simple 4-cylinder car. This guy wouldn't touch it. He's like, hey, I only work on Audis. Sometimes I'll work on Volkswagens if they're similar platforms to the Audis. But you bring me a Honda, Toyota, Ford, Lincoln, whatever, Chevy, I'm not doing an oil change. Like, I just don't, I stay with what I do. I'm an expert in that, only that. And this guy wouldn't even venture into like changing the brakes or doing oil changes. Forget about troubleshooting like issues, you know? And I think as a professional, one of the things that we have to develop is the ability to say no. As a professional, it's way more professional to say, I don't know, but the right person to speak to is this. It's a lot more professional to do that than have all the answers all the time. Sometimes we think we need to answer our clients' questions, but if it's not pertaining to our skill set, we're not being professional by dragging them through a conversation that they shouldn't be in with us.
True.
Okay.
So one time, my mom asked me a question related to accountant. So you know what I told her? I said, I always wanted to be an accountant. You guys didn't send me to be an accountant. Now I'm not going to answer your questions. She got upset. Just kidding. Just kidding.
Yeah, well, she will. Yeah, your mom would get upset if you say something like that.
Just kidding. Okay, thank you.
Anything else that comes to mind after this, you can go ahead and message me. I will share the article that I was basing this on. It's still read more. This is a very, very basic article with just the main points. But thank you for joining us. And this was meant to be like probably a 20-30 minute conversation. Sorry that it went longer. And you'll see why when you see the article that I based this on. It's very, very short. But again, any questions about this stuff, let me know later on. And if it's taxation related, I will also tell you to speak to an accountant. This is more on the actual changes, but if it's tax advice, I can help you. Okay, guys, thank you so much. And thanks, Shirani and Suman. I appreciate the kind words. We will connect again next week. Bye now.